So in today's video, we're going to discuss equity release and some of the horror stories of the product from the past. So to start off, what is equity release and what are the different products? There are two different types of products in equity release. You've got a lifetime mortgage and a home reversion plan. A lifetime mortgage is exactly that. It is a mortgage, but it's quite different to a normal residential mortgage. And it's different for a number of reasons. How much you can borrow is not determined on your income or financial commitments or term period, like a regular mortgage would be. It's determined on your age, largely, and the value of your property. If you've got any health conditions as well, that can also increase how much you can borrow. But all lifetime mortgage borrowers, they have to be at least 55 years old to qualify for a lifetime mortgage. And in terms of how much you can borrow, it's not based on your income or commitments, as I said. It's based on your age and the value of your property. And typically, you can borrow up to 50% of your property's value with a lifetime mortgage. The other type of equity release is a home reversion plan. This accounts for maybe less than 0.01% of the market. Most borrowers apply for a lifetime mortgage because it's normally far more cost effective. With a home reversion plan, a provider will purchase a portion of your property's equity for a massively discounted price. So once they own a portion of your equity, they'll obviously benefit from any capital appreciation in the property or anything like that, but they're often paying half or even less than half of the property's value for that share. So what is the history of equity release and why does it have such a bad reputation from the past? You'll be happy to know equity release is a very different product now to what it was back then. It's now got so many safeguards in place that I'll discuss in a second that make it actually one of the safest products on the market today. But when the product was first introduced, it was a bit like the Wild West really. The products weren't very well regulated. The Equity Release Council didn't have specific guidelines that brokers and lenders had to stick to. And a lot of borrowers, sadly, found themselves in financial hardship through equity release. So when equity release was first brought to the market, it was a very different product to what it is now. Interest rates were variable. They weren't fixed for life like they are in today's market. They were variable, which means that if clients didn't make monthly payments, and that's kind of the beauty of equity release, you don't have to make mandatory monthly payments like you do with a normal mortgage. But for people who don't choose to make those payments, the balance will just compound and continue to compound over time. So one of the big issues with lifetime mortgages in the past was that the interest rates, they were variable. So they went from, say, 3%, 10%, 15%. They would jump, go up and down very quickly. And this meant that, sadly, their equity was eroded very quickly when times were tough and when interest rates rose quite drastically. And people found that they lost a lot of their equity in a very short space of time. Thankfully, in today's market, the interest rates are fixed for life, so people know exactly what their balance will compound by if they let it compound at all. Because those monthly payments, they can be made if people prefer to service the interest or even pay off a portion of the capital every month or year. So after a lot of borrowers were stung by that initial equity release that wasn't as well regulated as it should have been, the Equity Release Council got involved and they brought in guidelines that their brokers and providers have to stick to in order to be members of the council. So for equity release providers, they have to have a no negative equity guarantee on all of their products. This means that a borrower can't possibly owe more than the value of their property when the property is sold. So for example, if prices fall in the market quite drastically, and if someone does owe more than the value of their property, even if they sell and they're in negative equity, that negative equity would be written off by the lender upon completion of the sale. This effectively means that any beneficiary of the borrower doesn't need to panic and worry that there'll be an extra debt on the property that needs to be paid. A no negative equity guarantee is in place by all Equity Release Council providers. On top of that, all Equity Release Council providers have to have their interest rates fixed for life with their lifetime mortgages. This basically means that if you take out a lifetime mortgage, you'll know exactly what the cost will be now and in the future. You can see on the illustration document exactly what the interest would compound by month on month, year by year, because the interest rate is fixed. There's no variable rate to it. This is unlike your standard residential mortgages where they tend to have a product term. You might get a 2-year fixed, a 3-year fixed, hell, maybe even a 5 or 10-year fixed, but after a certain product period, it would then revert to a standard variable rate. Whereas with a lifetime mortgage, It's fixed for life, so you don't need to worry ever again about being on a variable rate. You'll know exactly what the interest will compound by if you let it. Providers also have to give borrowers the ability to port their lifetime mortgage from one property to another. Now, just because this facility in place doesn't mean it's guaranteed. If the new property that someone's looking to buy doesn't fit the lender's criteria, or if the loan to value doesn't fit anymore, then it can still be declined. But you should speak to a whole of market equity release broker like Boon Brokers, and we can tell you your chances of getting a ported mortgage over to your new property. Another really important safeguard provided by the Equity Release Council is permanent rights to reside in the property until all borrowers pass away or move into long-term care. This is really important because it means that even if you decide not to make any payments at any stage throughout your lifetime mortgage term, no one's going to come knocking at your door and force you to move or the property be repossessed. That's not how it works with a lifetime mortgage. With a lifetime mortgage, you can stay in your property for life. However, if you don't make any payments at all, it just means that the lifetime mortgage balance will continue to compound. And because of the fixed for life interest rates, this is totally transparent from the get-go. You know exactly what your lifetime mortgage balance will be many years down the line because that interest rate is fixed. And the last safeguard in place from the Equity Release Council is the ability for you to overpay on the lifetime mortgage to clear off a portion of the capital. Now, this is different from lender to lender, but most lifetime mortgage lenders will allow you to make up to 10% overpayments of the amount outstanding or of the initial advance per annum, and that will clear a portion of the capital whenever that payment is made. So despite the misconceptions of equity release in the current market and the horror stories that you may have heard in the past of people losing their homes and losing all equity, the product is very much changed, and it is truly one of the most safeguarded products on the market now, thanks to the Equity Release Council, and it is suitable for many people in later life. So just because of the horror stories that you may have heard in the past, don't let this write equity release off for you. The best thing to do is to talk to a whole of market equity release broker like ourselves at Boon Brokers, and we'll tell you if a lifetime mortgage equity release is suitable for you or not. If it's not, we will have recommendations for other products, retirement interest only products, even normal mortgages, and we'll always advise the best product for you.